Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, September 16th. Major US indices hit fresh record highs yesterday ahead of the Fed decision this week. Big tech led the rally. The US yields and the US dollar remain under pressure, but some out there actually think that the Fed cuts may not lead to a fresh boost in risk appetite if they sound more politically motivated than economically justified. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yesterday was just another day of record highs for the S&P 500 companies on optimism that one, their earnings grew around 13% last quarter and the profit outlook has been improving since the summer months, and two, on the expectation that the Federal Reserve is just about to start a fresh monetary policy easing cycle to fight the weakening jobs market in the United States, provided that inflation in the US remains under control. So, the sweet combination of strong earnings growth for the S&P 500 companies and lower interest rates in horizon is simply too good for investors to jump off a running bull. So, equities are trending higher, and as per the Fed and the rate cuts, many expect that the Fed will announce a total of 100 basis point cuts over the next 4 monetary policy meetings. So if you think that there is some kind of a mismatch between the S&P 500 companies' outlook and their valuation and economic and the Fed outlook, well, obviously, you are not alone. And it is, well, simply because the S&P 500 companies don't necessarily represent the US economy. Because a third of the S&P 500 is made of big technology companies. NVIDIA alone stands for about 8% of the index. And these big technology companies do have very deep pockets, and they have been buying things from each other. Think of NVIDIA, for example, that sells its high quality chips to Microsoft, Google, and the likes, for example. And obviously, this little ecosystem, combined with the global demand for the US technology stocks and for AI, has kept the major US indices, including S&P 500 and Nasdaq, obviously, in demand, and that despite the signs of economic weakness in the United States and the other pockets of the market. And for the rest of the S&P 500, so the S&P 493 we call them, well, earnings growth last quarter was around 3 to 4%. And you can clearly see the S&P 500's equal weight index remain behind this technology heavy and market cap weighted version. So the weak economic outlook for the US economy and the deteriorating jobs market in the US are not necessarily a cause for concern for the US big technology valuations, but the prospects of lower interest rates in the US are clearly a positive thing because they actually make their valuations, the big tech valuations, juicier. That's simple math. As such, this week just kicked off at fresh record highs for the S&P 500 Nasdaq, as I said, as the US 2-year yield that best captures the Federal Reserve rate expectations remain under the pressure of dovish for expectations. Google jumped more than 4% on Monday and hit the $3 trillion valuation fueled by the news. Earlier this month, remember that the company, well, doesn't need to sell its crown. And that, combined with AI demand, is actually pushing Google higher these days in a delayed fashion almost. But we always said, remember, that companies like Meta and Google would be the fresh leg of the AI rally, the second phase of the AI rally, because these data-rich companies are actually very well placed to benefit from AI because they have a huge amount of data to train them. And as per the icon of the global AI rally, NVIDIA, well, the company opened the week lower but closed the session having held ground below the 50-day moving average and quite flat, and that despite the news that China is now going after NVIDIA for having violated antitrust laws on a high-profile deal back in 2020. Now, that's obviously a piece of news that curiously comes just at a time the Chinese and US officials are discussing about the trade terms, TikTok and about how the US is really not happy with the country buying the cheap Russian oil. But anyway, as the talks continue, there are also rumors that the trade truce could be extended with China, and India could eventually find a trade agreement as well with the US. So we are waiting to see what happens, but good news is that trade news no longer impact the market sentiment negatively. So, does that mean that it's all rosy now, we're out of the woods? Well, I would say almost yes, why not? Because the correction that I have been waiting for this summer just hasn't happened, and the underlying fundamentals in the markets have actually turned positive in the meantime. The US exploding debt issues, for example, have been almost forgotten. The trade war between the US and the rest of the world and the negative implications have been quite well digested by the markets. The Trump administration's interference with companies' private affairs, I am looking at you, Nvidia, for example, and the Fed's affairs and the Fed policy have also been quite well swallowed, to be honest. And now the Fed is convinced that cutting the interest rates is indeed the right thing to do. So it all looks, well, quite positive right now, especially from the market perspective. And on the politics side, while Stephen Murin has been confirmed as a voting member just in time to participate to the Fed meeting that starts today, while the Fed's Liza Cook will likely be part of the meeting this week as well, despite Donald Trump's efforts to oust her. Now, beyond the interest rates, we will also have an update to the so-called dot plot of the Fed that will give us an idea on what the Fed members expect to do beyond this month's monetary policy decision. And as I said before, many out there now think that there could be around 425 basis point cuts on horizon for the next 4 or maybe 6 months, and that will more likely than not give a fresh boost to equity markets. And the small and medium-sized companies and companies outside the technology sector and outside the United States are also enjoying this ride. Mind you, a gauge of Asian equities just hit a fresh all-time high level this morning, again after doing the same thing yesterday morning. Now, looking at the past, some sectors actually perform better than the others in different rate scenarios. And in the sense, according to a research from Ned Davis Research, for example, while the median gain in the S&P 500 in case of 4 or more interest rate cuts after a 6-month pause, which is the case today, was around 20% for healthcare companies, nearly 20% for consumer staples, 18% for energy companies, and around just 1.6% for technology companies, suggesting that 4 or plus rate cuts happen mostly during the times of bad economic conditions, and they help the defensive sectors perform better, while a 2 or less rate cuts have been better for industrials, energy, and financials, which are cyclical stocks, suggesting that lighter rate cuts happen in not so bad economic conditions and explain why the cyclical sectors benefit better than other sectors. So we will see how many Fed cuts are on the menu of next month and how markets will react to them. But note that still, some, like the chief strategist of JP Morgan, for example, suggest that investors could eventually lose appetite when the Fed actually starts cutting the interest rates if they believe that the rate cuts are more politically motivated than economically justified. And the latter would be true if, for example, the Fed decided to cut its interest rates by, 50 basis points this month and or announce more rate cuts in the next 6 to 12 months than necessary or expected by the markets. But for now, the dovish Fed expectations remain quite supportive of risk appetite across the globe. The US dollar remains under the pressure of dovish Fed expectations and prospects of lower interest rates. Gold and silver continue to push higher for the same exact reasons, while US crude is consolidating gains this morning near the middle of the $62 to $65 per barrel trading range, waiting for fresh direction. So all eyes are going to be on the Fed decision this week, but still keep an eye on the US retail sales data that is due just today. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Thread, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.